Right. Well, let's as we've had a bit of a delay. Let's jump straight on into it. We had a very interesting session when you were last with us, looking at a number of different things. But I think this week, obviously, I think it's worth talking about where we are. Everybody knows that in 2020 was the coronavirus pandemic, and there's been going to be a long-term impact to that. So really, to start off with, what's been the impact of coronavirus on government budgets and on sort of the way that the governments have financed the response to the coronavirus pandemic? Because there's obviously been lots of government responses, things like Eat Out to help out, the furlough scheme, etc. What's been the impact on government finance of those things?
Well, it's a bit like what it was during the war. Spending has just been, they just have to spend whatever they have to spend to get what they want to achieve, which is basically to try and keep everything going as near to normal as they can and try and keep as many businesses in business as they can. But the government doesn't actually have any money of its own. The only money that the government has is what it takes off people in taxes. And they were already in quite a big deficit even before coronavirus hit. So they've massively expanded government spending, but it's all effectively been financed by printing money.
So when you say printing money, I mean, it's not like the Bank of England is literally just got a big machine in the back and it's printing banknotes. I mean, the main method has been through quantitative easing. So how has that actually worked? What's the mechanism that governments have been financing this spending through? Because I mean, most of the time you would think that debt is taken on by the government borrowing money from people like you and me, institutional investors, etc. Is that not the case this time?
Not really, no. I mean, okay, let's take an example. Let's assume in example A, the government's in balance, and then it expands the deficit. Normally, if the government goes into deficit, it sells gilts to the non-bank private sector, i.e. people like Legal and General and Post Office Pension Fund, whoever, So institutions and private investors buy those bonds, and basically they finance the government deficit. What's happened here is that now it's illegal under the law for the Debt Management Office or the Treasury to sell gilts directly to the Bank of England, because that effectively is monetising the deficit. So what they do to get around this is that the government will say, sell a new gilt, UK Treasury, whatever, 1% of 2030 or something. They'll sell that to Legal and General, which is perfectly within the law. And then the very next day, the government will buy back another gilt from Legal and General, say, that's been in existence 6 months. So the monetary effect is it gets around the law that the government can't monetize the deficit, which is it is modern day printed money, but it's electronic money rather than banknotes. Gets around there by issuing new gilts to the institutions, which it can't sell directly to the Bank of England, and then the Bank of England buys seasoned gilts back from the same institution. So the effect is the same. Is that the Bank of England ends up with, which has no money also itself, ends up owning loads of gilts, which it then also, as a side effect, foregoes the coupon on. So what's happening in effect is that the Treasury, through the DMO, is selling gilts directly to the Bank of England, which is technically illegal, but they get around it by this buying existing gilts in rather than directly new ones.
So obviously the impact of that is that, I mean, it doesn't feel like that's been normally, if you open a school textbook and you think of printing of money, that would be extremely inflationary, but we've been in an extremely low inflation environment, so it doesn't seem to have had the same effect as that you might expect, that our listeners might think, well, if we're printing money, why haven't we got runaway inflation? Inflation's been low for the last few years.
Okay, well, if you go back to the original QE1, QE2 and QE3, they were not inflationary, because what was happening is that this quantitative easing expands the narrow measure of money supply, M0. It directly, the Bank of England's balance sheet is effectively the same as M0. So M0 goes up, but there's other measures of M as well. There's M1, M2, M3. And in QE1, QE2, and QE3, it didn't feed through to the wider measures of the money supply. It only affected the narrow measure of money supply because there are other things going on. And the money tended to stay inside the banking system. This time it's a bit different because A, it's much bigger in scale. QE1, QE2 and QE3 were condensed, sort of spread out over a sort of 6-year period. Whereas this one has printed in America, especially, and over here, far more liquidity has been created in a space of months. And this time, a lot of the money, because it's been used to finance government spending, has actually got into the real economy in a way that the previous QEs didn't. The other factor why you didn't get inflation is during the 6 or 7 years, the previous QEs, were the velocity of circulation was falling. Particular examples in America. Velocity of circulation peaked in America in 1999 and has been falling for 20 years in the run up to the crash of 2007, but also after the crash. So as fast as post 2007, when Ben Bernanke introduced QE, as fast as the money supply was rising, the velocity of circulation was falling, and they tended to offset each other, which is why you haven't really seen any consumer price inflation. Now, because the money stayed inside the banking system, what you have seen is asset price inflation. And a lot of people think that the main reason the US stock market has been so buoyant is because it's been liquidity driven by this money creation. Now, again, what we think is that QE4, or the latest one as a result of COVID, is different. The reasons velocity of circulation were falling, we think, was it's very much tied to the labour participation rate, which peaked, which is the retirement of the baby boomers. And also in 1999 was really the start of globalisation and buying things on the internet worldwide. So those two things over 20 years exerted a massive deflationary impact on the entire world. But they're one-off events. The baby boom retirement of all the babies that were born after the war, that's largely played out. And the globalization, all the factories and everything is transferred over to China. That again is a one-off event, a massive one-off event, but it's largely happened. So they're non-repeatable. So what's happening now is that velocity of circulation, once you allow a bounce back for the COVID situation, velocity of circulation has really stopped falling. It will stabilize. But the M side, the money supply, is growing even faster than it was. So you've got M2 in America growing at 25% a year last year. It never grew anything like that in the previous crash. So as a result, we think the deflationary cycle ended in March 2020. And what you've got now going forward, you are going to see much higher inflation, far higher than most people imagine.
So QE is part of the puzzle, but what else is going to, obviously your thesis is counter to a lot of people in the market who are saying that inflation is going to remain low and like interest rates is going to remain low over the medium term. What other factors do you think are going to lead to increased inflation? Okay,
well, you don't necessarily have to forecast inflation. Inflation is a year-on-year rate of change. So the two key dates to look at are March 2020 and March 2021. And if you take oil as an example, as everyone knows, oil went negative in March 2020. But if you be generous and assume that the price of oil in 2020 averaged $10 a barrel, if you fast forward now, you've only got to go a few weeks now into the future, into March 2021, and oil is just under $60 a barrel. So there's a 500% increase in the price of oil, year-on-year comparison. Once we get through to March, April this year, then the year-on-year comparison takes March 2020 as the base level for future price increases. So oil is up more than fivefold. The price of all the food commodities also bottomed in March 2020. So your average food stuff is between 50 and 70% higher than it was a year ago, or sorry, a few months ago, but it will be a year when we get through to March. All the metal prices have gone up. So you don't have to forecast inflation. It's already happened. I'm not forecasting oil is going to quadruple or go up fivefold. It's already gone up fivefold. And unless it goes back to $10 a barrel by March, that fivefold increase in oil starts to get factored into your year-on-year inflation. So you don't have to forecast it, inflation. It's already occurred. You've just got a question of waiting a few weeks till it starts to show up in the statistics. And it's not just, it's finished goods as well. So everything's gone up since March, massive increases. But also finished goods. If you take something like, say, Chinese television or something, everything, 80% of the world's manufacturing product comes from China now. Take a television. So since over the last few months, copper, nickel, silver, all the hard metals and stuff that go into making a television have all gone up massively in price. Silver's up nearly 200%. Also, so all other things being equal, the price of that, the Chinese manufacturer will increase the price of his television to his customers to take into effect to his higher metal prices. Plus, since the last 6 months, the Chinese renminbi has just virtually gone up every single day. So it's gone up by about 8% against all the Western currencies. So Chinese television today will probably cost you 13, 15% more than it did in March last year. So everything's gone up. And you don't, this is not a forecast, inflation. This is an observation that once the inflation that's already occurred in the last 9 months starts to get into statistics, the statistics will go up. I mean, it's incredibly easy to prove. It's just a question of waiting a few weeks till it shows up in the numbers. And it can't not show up in the numbers. You can't have a more than quadrupling of oil prices without it starting to push prices up. That's what inflation is. And it's fueled by this massive amount of liquidity, which is just adding fuel to the fire, because any investor or hedge funds, once the momentum starts to build up in copper and everything else, people jump on the bandwagon and start buying all these commodities, which is just accentuates the trend. So it's unavoidable. So all these bond fund managers that keep going around saying, well, there's no inflation, they're just talking their book. They either can't work out that the inflation has already occurred, or they're deliberately trying to play it down because they're terrified people are going to withdraw huge sums of money out of their bond funds.
I mean, to give you a bit of challenge there, I mean, everything you've said is obviously true, but it all sounds like you were describing the deflationary things as one-offs. These all sound like things that are going to be one-offs as well, and it's likely that investors and markets will or may look through them if it's a temporary, if we have a temporary blip of high inflation for Q1 or maybe even H1 of 2021. Are investors not likely to look through that? I mean, the big thing that if I open my economics 101 textbook, everything you've described, would lead to consistently high inflation, except that we haven't got a tight labour market. When I look at my economics textbook, the all the requirements are there, except for the fact that we've gone from having a tight labour market to very, very, having a lot of slack in the labour market. So how does that sort of feed into your thesis? And do you think that inflation will carry on and not just be a blip? It will be a consistently higher inflation for a period of time.
Okay, well, when you say it's a one-off, I mean, it's a 20-year one-off. The deflationary wave started in 1999, and it's lasted 20 years. But that's now all behind us. Secondly, with regard to wages, I suggest when your textbook may have been written, a lot of the manufacturing would have come from Britain or from the United States in the West. Now a lot of that's been closed down. It's all been outsourced to China. So the key ingredient for wage levels and employment is Chinese wages, not British wages in terms of manufactured product, because most of the manufactured product comes from China. And in renminbi terms, Chinese wages wages are going up. And then when you allow for the fact that the renminbi itself has gone up 8%, 9% across the board in the last 6 months. So that's where your wage increases are showing up. They're showing up at the point of production, not at the point of the customer buying the goods. And in terms of, is it going to carry on? Absolutely. We're 6-9 months into what we think is one of the biggest bull markets in commodities the world's ever seen, fueled by huge amounts of printed money. So this move up in copper's up 70%. Every single commodity you look at's up 50, 70, 80% in the last 9 months. And we don't think it's just a one-off, it goes up for a year and stops. If you had a 20-year down wave, likely as you'll have a lot more than a 9-month up wave. So we think this is a multi-year bull market in commodities. The liquidity that's going to drive it, it's going to result in all sorts of other side effects. So for example, it'll affect different sectors of the equity market in different ways. But no, absolutely not. We don't regard this as just a one-off. It's not like saying, oh, well, oil was $50, it went down to 10, now it's back to 50, and then it stays at 50 for the next 3-4 years. We don't think that's going to happen at all. We don't think it's going to happen with copper either. We think this is the start of a multi-year bull market in all these commodities. And that's your best underlying guide to the inflationary, deflationary balance in the world economy.
And what's going to drive, in your opinion, the continued increasing of obviously you've said, it's just there's a cyclical element to it, that if you've had prices, reducing for 20 years, you expect, when it turns, you expect them to increase for a period of time. But is there any, rather than just, the swings and roundabouts, is there any specific trends that you think are going to push commodity prices up?
Okay, well, let's take decarbonisation and electric cars. It takes 4 times as much copper to make an electric car as a petrol car. If the whole world wants to move towards driving electric cars, there just physically is not enough copper in the world at current levels of supply to supply anything like the car industry in the amount of copper it's going to need to buy. And it's not just copper, it's silver, it's all the metals that go into building an electric car. The demand for these commodities so far exceeds the likely supply that the only way it can be resolved is by massively higher prices in metals like copper. And you're starting to see that. I mean, in our equity fund that we run, we've been on this theme for a while now. And our fund was at the top of the league last year, as you know. And the reason for that is because it's overweight in all the metal miners like Rio Tinto Zinc, which, if you look at the share prices of these metal miners, it's starting to reflect the fact that there's a huge boom. The world cannot supply the amount of metal that's required to decarbonize. And if you don't use these metals, you can't decarbonize. You can't do without a petrol engine unless you replace it with an electric engine at the moment. And that electric engine requires massive more amounts of metals like copper. So the only logical conclusion you can draw is that the price of copper is in a multi-year bull market because of the demands placed on it by the green energy. And it's the same thing with wind farms. You can't build a wind farm without copper. You can't build a charging station. It's not just the cars. It's a whole gamut. So that's just one example of where you're going to see much higher commodity prices as a result of real changes that are taking place in the economy.
So if we look at your thesis that we're going to see sustained higher inflation, what in general is that going to mean for asset classes? Obviously, we've got the classic split between asset classes in bonds versus equities. So what do you think is going to be the knock-on impact of higher inflation on those two asset classes?
Well, we already see it. I mean, I don't think necessarily, as you've seen through COVID, certain sectors of the equity market will thrive on inflation. The big no-no under all this is fixed income. Gilts and Treasury bonds are going to get absolutely decimated. If our scenario is correct, bonds are an absolute disaster waiting to happen. And it's already happening. It's only in the last 2-3 days. I mean, as you know, I wrote all this stuff out long before Christmas for you. I haven't changed any view. It's all starting to unfold now, as we thought. The last 2 days, 10-year Treasury's gone through 1%. We think this is just the start. We think there's 1% on its way to 1.5%, probably on its way to 2%. Massive bear market in bonds, massive bear market in gilts, and you've got all the supply as well. So the problem is if investors are going to buy these bonds, it's all very well when these bonds were in a bull market, investors would buy them. But you start having a situation where every time they subscribe for some bonds at an auction, they lose 5-6% of their money at the time the next auction comes around. All of a sudden, you get a marked reluctance by investors to buy these bonds, which then puts more weight on the shoulders of the central banks to finance the deficits, because the deficits aren't going to go away. So you've got massive supply of bonds coming along. If the central banks start monetizing even more of the deficit than they are, you cause even more inflation. So bonds are just not going to be a good place to be. They're on negative real yields at the moment, and they're just going to be now equities. There's certain equities, especially real asset equities that we've talked about, like copper mining companies, but also even house builders, lands, property companies, anything that has real assets that go up in line with inflation are going to thrive. Possibly, and the other thing that's going to happen, which you're already starting to see as well, which you thought would happen, is that as bond yields rise, it massively swings the balance away from the new economy stocks like tech shares towards the old economy stocks, because the old economy stocks are jammed today stocks. You get nice big dividend yields, they make profits, blah, blah, blah. All these tech shares, a lot of them don't make any profits, so they're jammed tomorrow stocks. It's all based on how many customers they've got. They don't actually make any money. I mean, you take Tesla, strip out its carbon credit sales, and it loses money still. Now, if the bond yields rise to 1 or 2%, you then have to use a much higher discount rate to discount back those future earnings and profits. So it's going to massively swing the balance away from the tech shares towards the value stocks. So it's the rise in bond yields that will trigger this. And that's, again, you started to see over the last few days, at the minute the Treasury bond rises, the NASDAQ starts going down and the other sectors of the US equity market start going up. So you start seeing, and also you're seeing huge outperformance. I know it's only a few days into the year, but things like the FTSE, I mean, that's possibly a post-Brexit bounce. But again, there's a lot of old value type stocks in the FTSE 100. FTSE 100 has been outperforming all the other markets so far this year. So, there's knock-on effects. But the big thing that's going to happen is that bond investors bonds having been a safe store of value for the last few years are now going to be anything but. They're incredibly dangerous. They're on negative real yields. The rate of inflation kicks in, and the bond yields, in our view, have to go much higher than they are at the moment. And the more the commodity prices go up, the more the bond yields will go up. And that's pretty much that relationship has been tested over decades, and it's very powerful.
I think our listeners would be interested in sort of zeroing in a bit on one part of that you said, which was you expected gilt yields and to increase, and therefore obviously the value of gilts to fall, because a lot of our listeners are local authorities. Their borrowing rate is based upon the prevailing gilt yields. So again, to challenge your thesis a bit, I mean, most people trading gilts in the market will be seeing them as rates instruments. There's nothing that I can see in your thesis, though, that tells us that even if there is higher inflation, that the Bank of England is going to respond by increasing rates. I know that seems like a bit of a silly thing to say, because that's what they're supposed to do. But with the economy sort of quite weak post-coronavirus and them not wanting to choke off any growth we do get post-Brexit, it seems to me that there's a chance that actually in the specific case of gilts, I think that your thesis can be correct, and gilts still retain their low yields because people treat them as a rates instrument, but also there's sort of an institutional hunger for these things, that they're actually required, that people need to hold them, and they, even with the Bank of England buying them and the monetization of the debt, of government debt, still having that impact on yields. Do you think that that can sit with your case, or do you think that it just has to happen that gilt yields will rise?
No. Okay, let's just first of all define what you mean by yields. Do you mean 3-month yields or 6-month yields, or do you mean 50-year yields? I agree with you that the Bank of England is going to respond to this by not putting rates up. I don't see any increase by the Bank of England in interest rates, i.e. overnight money, 3-month money, maybe for years. But what the Bank of England has absolutely zero control over is the price of 50-year money. So what we're saying is going to happen is you get a much steeper yield curve. So the long end of the gilt market starts to go down very sharply in value, but the short end stays roughly the same. So you just end up with a much steeper yield curve. And you're seeing it in America as well. You're seeing that they don't have such long bonds as we do, but the yield curve there is steepening like crazy as well. So the Fed's not going to put rates up, but it's not stopping a bear market in US Treasuries. It's a yield curve steepener, but a big one. So for your local authority clients, it depends where they're borrowing money. If they're borrowing money at the short end of the market, not much is going to change. But if they're looking to borrow money at the long end of the market, they're going to find potentially paying a lot more money, a lot more for their money to borrow it.
I see that's an interesting point. I mean, obviously every client is different, but I think generally we would our clients would be staying away from the 50-year the 50-year maturity money. But it's interesting to me at least that you think that lower rates, that lower for longer situation, can sit comfortably with higher inflation and with all of the things that you and sort of a bear market in gilt, because when you sit there and think about it, that's slightly counterintuitive, but talking about it, it does sit with your views relatively well. So I think, from my point of view, I'm struggling, and maybe this is going off topic a little bit, but I think it's an interesting again for our clients to go in on. I'm trying to think of a situation, an inverse situation where we do see rates increasing, and at the moment I can't really see it. I'm interested in your views. Is there a counter argument where you can think actually there is a realistic situation where we might see rates increase? Because personally I don't see one.
No, I don't see one either. If you place yourself in the position of Rishi Sunak or Bailey at the Bank of England, they're locked in. There's nothing they can do about this other than let inflation rip. They can't put taxes up to finance the COVID spending because they spent so. It's not possible to raise even remotely a fraction of what they've been spending and printing in honest finance by raising taxes. That's just not possible. You just can't raise anything like enough money in taxes to pay for it. So taxation is out. They can't put up interest rates really for a whole variety of reasons, the weakness of the economy and everything else. So rates are stuck here. I agree with you for possibly years, and the only policy option they've got is to let inflation rip. And actually, despite how much they'll wail about inflation, with the amount of public debt outstanding, the best thing that can happen to the UK Treasury is to inflate that debt away. That's because if they don't inflate it away, somehow it's got to be financed through taxation, which will be crippling. So it's a lot easier and a lot less painful for the authorities to inflate this debt away, which is what they've always done. They always claim they're not doing it and they're going to fight inflation. At the end of the day, if you look at it from their perspective, there's no incentive to fight inflation. They say the right things and quietly go off and do the opposite. So I agree with you. Rates aren't going up at the short end. I 100% agree with that. But the Bank of England or the authorities have absolutely no control over the shape of the yield curve. And if they did try and introduce yield curve control and start buying 50-year gilts in the market in some king-canute attempt to try and stop the yields rising, it's guaranteed to fail, because if the market is worried about inflation, you don't cure their worries by causing more inflation, which was what yield curve control would involve. So all we're talking about is higher inflation and a steeper yield curve, but rates unchanged at the short end, which is quite a very bullish background for large chunks of the equity market. So for us, it's quite simple. You just avoid gilts and put as much money as you can to work in the equity market, and especially in the inflation-proof sectors, which has worked for us over the last year. It's worked brilliantly, and we just see more of the same. Only, if anything, at a sharper rate than what we saw last year. We think the trend of all this is going to accelerate.
Well, that's been really interesting. I've really enjoyed this. I do notice the time is starting to tick on. If we could just move on to the last slide, which I know is just a quick scorecard of how Charteris has performed, and give our clients a chance to look at that whilst I sort of finish off and ask you a final question. Obviously, your view is that we're going to have significantly higher inflation. Do you think that significantly higher inflation is going to be relatively stubborn, and that we're going to see an increase in yields at the far end? I'm putting you on the spot now, but do you feel confident in putting some numbers next to those? Do you think that probably not on inflation, I think that's unfair, but when it comes to longer gilts, do you think we're going to be seeing yields in the 5% range, or is that still a bit too far away, or am I undercooking it? Are we looking at much higher yields even than that?
What are we looking at for just 2021, or are we looking?
Yeah, just over the next 12 months.
Oh yeah. Well, start off with the US Treasury market, which everything's priced off that. We've just gone through 1% in the 10-year. We're heading towards 2% in the 30-year. We could easily see the US Treasury go to 1.5 or 2% over the course of 2021, and there were similar sort of increases in the gilt market. Problem you have in the gilt market is you've got 50-year gilts, and they're much more volatile, so your potential price losses there are greater. In terms of equities, when you look at that performance, now our equity funds top of the sector over 5 years. That all the things we've been talking about commodity upswings, most of that performance in that equity fund has come from having an overweight position in metal mining stocks, which this has been our theme for the last year, and you can see how much it's paid off. But we think this is only the start. We don't think this is 2020 was a one-off, and it just led to these funds outperforming. These funds are all top of the league over 5 years, not 1 year. But as bull markets develop, any bull market, it doesn't matter what it was, it tends to start off slowly, and then the trend starts to hot up a bit as more and more people get attracted to the story. So we think 2021, especially post-Brexit in the UK equity market, which is really interesting, because even though we're 5 days into the year, the FTSE's already up 5-6%. It's way outperforming the DAX and the French market, partly because all the worries of Brexit have been out the way, but also because the UK equity market was selling at a big discount relative to other sectors because of Brexit, and also all the sectors that we're talking about, because the other sector that benefits from a higher yield curve is the banking sector. That's been under the cosh for a while because of the shape of the yield curve. If the shape of the yield curve sharpens steeply, all of a sudden the banks start making a bit more money. So it livens up the banks and the potentially insurance companies as well. So more of the same, but the move up in gilt yields affects different sectors of the equity market in different ways. But the big loser, apart from fixed income, is going to be tech shares. All the jam tomorrow, which don't make any money at the moment, the market's discounting their profits 5 years out. The gilt yields and treasury yields go up. You've got to use a higher discounting factor to come back to present day value.
Well, thank you very much. I found that very interesting and certainly challenged a few of my assumptions for 2021. So hopefully everybody else has found it as useful as I have. So thank you very much, Ian. That's been really interesting. We have come to the end of our time. Do tune in next week, everybody, for our session with Richard Maguire of Rabobank. As I said, we've got some great at the beginning. We've got some great episodes and sessions coming up over for 2021. Do make sure you're following us on things like LinkedIn and Twitter, where you'll get regular updates, and check our insights page on the Arling Close website, where we regularly update with insights from members of the team. So all that really leads me to say is I hope you all enjoyed the session. We didn't get any questions, but if you do have any questions for me or any member of the team or for Ian, please do either stick them in the chat and we'll drop you an email, or drop me an email and we can respond. But all that I usually say is thank everybody for listening, and thank Ian again for joining us and being such an interesting guest. Thanks very much, everybody.
All right. Cheers. Bye.